Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Good morning. It still is. Gem, how are you going?
I'm great. How are you?
Good. We've got royalty in the studio for the final episode. It's Gemma Mitchell, financial advisor and money coach, and I'll be weighing us down for this Q&A session. You've sent in your questions over summer. I've got some absolute crackers in here, a bit of fun, a bit of quirkiness, and we're going to try and attempt to answer your questions that you send in to us. But the good news is if you haven't got your question in time, and we've got a lot of questions that we're not going to be able to answer in time today, so you can send them in via the link in your podcast player, or if you're on a Rask website, scroll down to the bottom. There is a thing that says ask a question. Just select the Australian Finance Podcast, and hopefully Gemma's going to come back and answer some more questions with me. So we can get some free tips and tricks on the show. On that though, it's really important to remember that we don't give personalized financial advice via a podcast. We don't know your needs, goals, or objectives. So any of the information that we give you is strictly general in nature, and you should refer to a financial advisor who can take into account your needs, goals, and objectives before acting on this information. If we mention things like super funds, bank accounts, insurance, those things come with a few legal documents, including a PDS, a product disclosure statement. An investment, like an ETF, may even come with some other documents or some sort of guide that's available on the issuer's website. If we have any financial interest in anything, of course, we'll disclose that to you. In this episode, I highly doubt we will have any interest whatsoever. So, Gem, the first question, which is, I guess, a nice one because it was directed straight at you. It comes from Soul Trader, S-O-U-L, not S-O-L-E. Soul Trader writes in and says, this one's for Gemma. I'm a sole trader whose income lands in my account on a daily basis in varying amounts. What are some good budgeting strategies? I find it difficult to apply the set percentage buckets that people with fixed monthly incomes can use.
Mm-hmm. I love this one. It's a very common problem, and it's a problem that I also have. So the way that I organize mine that really works, and I probably now get most self-employed people that I talk to about, is the concept of, I need a cooler name for it, but it's like a cascading budget. So if I was this person, sole trader, I would be setting aside some time, however often you want, probably weekly, probably not longer than weekly because it might get a bit hectic, but say you set half an hour aside each week in your calendar, but it would have a cascading budget. So you need like a $0 budget, I guess. So you want to have all of your expenses, but then you want to put them in order of what is the most important. So for me, it's going to be rent, loan repayments, food, transport, bills account. Then it's going to go down to my discretionary spending, that, all the other savings. So it's all in order. And then as money comes in, I'm ticking it off. Yep, cool. I've moved that money over into the rent account and I've done the whole amount. Great. Now the bills account, I needed to put $200 into it. That money came in. Yep, tick, I've done it. And it's just going down. If there's any left over, great. I can decide where it goes after it's ticked. But if it didn't cascade all the way down, and I've missed those other ones, maybe next week when the money comes in, it gets replenished. So it's a bit more maintenance, there's a bit more involved. You can't do the automations, but maybe actually you could do a bit of both. So maybe that when you do your budget, the first 4 are always covered. I never earn less than that. So I'm going to automate them each week, and then I'm going to do the cascade as other money comes in. So that's how I would do it. Just really manual, unfortunately, but you're on top of it. You're looking if you're running a business, sole trader, you're probably managing stuff like invoices and that. Anyway, while you're doing that, make sure you're ticking everything off in your budget, and make sure you have things in there for, you know, maybe there's business expenses that you need to keep a buffer in your bank account. Maybe every time you get paid, so that week you look at what came in, you've got to swipe that % for tax. Just making sure all those things are in your budget, but putting them in priority and then letting it trickle down.
I mean, we've all been here, haven't we? With the variable income. It's not easy.
It's messy.
Yeah.
But you just got to find what works for you and what is going to be most sustainable.
I'm going to make a tip for a service that, again, no affiliation, but we did an interview with a Kiwi, that's New Zealand, not the fruit, startup now, big business, I guess, a great business called Henry, HNRY.
I see them everywhere.
Yeah.
I thought they were tax.
Yes, they are, but here's the quirk. So it's for sole traders, pretty much only sole traders. They won't like me saying that, but that's basically what it is. And what happens is they set you up with a bank account and you pay 1% of your turnover. So like it's kind of like a zero if people are familiar with like accounting software. So it does all of that. But what happens is they set you up with a bank account and it kind of reads the income that comes in and helps you invoice and do all that. It withholds 1% of the income as their fee, but up to a fixed amount, so it doesn't go above that, which is cool. They do your tax return every year, right? And you can treat it and you can allocate money to different things. So it's perfect for a sole trader who's like variable income, needs to pay an accountant, doesn't know how to do that, and it estimates like tax. It can do all that. It can withhold. It can help you streamline everything. You want to make sure that you know what's going on, but they've got accountants on demand and stuff like that. And eventually you might grow out of it. You might grow into zero if you form a company or something like that. But Henry without the E, remove that E.
Yeah, and I think it's so important to like adjust and move. So right now it might be simple enough that you can do this approach with the spreadsheet, and then you might go, oh, it's getting a bit more complicated. I'm going to go to that. And then you might go to zero. Like it's okay to outgrow professionals. It's okay to like you for your budget and things to evolve.
Yep. The next question comes from Mr. Ring. I wasn't sure where this was going to go, but over a year ago, you did a podcast about ways to save money, and something you mentioned was about an engagement ring. Could you please let me know the episode if you recall? Much appreciated. Well, I'll tell you what, I'll give you the answer to what you're looking for. We were just talking about this off air. I bought my partner's ring through a website called Jogia Diamonds. It's spelt, and I'll make sure I've got this here, Jogia diamonds.com.au, Jogia Diamonds. I'll put a link in the show notes for any folks out there who may be doing a bit of a secret purchase in a good way. This service is effectively wholesale diamonds online, but it's not one of those fake wholesale diamonds online. I was just explaining to you, like where you can search. This is a pro tip for anyone. You can go on the international market looking for diamonds, and there's something called a GIA number. This number is unique to the diamond. It basically stopped like blood diamonds and all that sort of stuff coming out of, bad situations. And basically what this is it's invisible. You can't see it because you need a special like magnifying glass to actually see this number, right, Gem? But it enables you to verify that what you've actually bought is the actual diamond. And so you can go to a jeweler and they'll look at it and they'll be like, oh, yep, that's the number. And you'll get a certificate when you order through this place called Jogia. But to give you a sense of it, I think that on average, it would have saved me 100%. Like if I went to a retailer, I would have paid 100% more than what I did pay. There is a downside. Obviously, it's freakish ordering something that's valuable online like that. I think more people are comfortable with it now. You can get them to build your ring for you. They have some set selections. But I got it built myself. And what I found out is I was like, I'll just buy the diamond, go to the diamond, like whatever you call them, the jeweler that I like, and they'll do it. And what I found was none of them wanted to touch it.
Oh, really? Why?
Well, I eventually got someone and he was great. But the reason that they didn't want to do it, I think they said it's because they didn't want to risk someone else's diamond or whatever.
Wrecking the diamond. And
that's what they said. But I think it was because they didn't make enough margin.
Maybe. Yeah, because I also, when I got engaged, we got the family stone. So we already had the diamond and we got it put in a setting, and I just took it to a local jeweler that I'd seen their work before, and we designed it together, and he made the wedding bands and everything. And I think it was only a couple of $1,000s. which you think for an engagement ring is really good.
Yeah.
And that's because it was only the setting and I think a few smaller ones. But yeah, I went to a few and they were all happy to
maybe it was just, I don't know, maybe I just presented them the wrong way with ripped jeans and a hooded t-shirt or something. I don't know. Maybe who knows what it was.
But yes, there would be a risk. Like that would be scary. Like imagine if you,
but
they'd have insurance for that.
Yeah, but then I went back for my ring, right? And they got a lot of business out of us, that's for sure. At least I felt it. And I would just say that's in a way to do it. I designed the ring and all that sort of stuff. And it worked out right. Took the other rings that she had down to the jeweler to get the approximate size. It was really good. Got the insurance. There's specialty insurance for them as well that you probably want.
And I think also like it doesn't have to be a diamond. Like not everybody is a diamond person. Like maybe it's a gemstone or maybe it's a lab-grown.
One. They're a lot cheaper.
Yeah, and then there's like different ethical reasons that people might want different stuff like that. A friend of mine, when they got engaged, like one of their first dates, they went like is it fossicking?
Yeah.
They found a gemstone and he kept it the whole time and then got it made into a ring for her for the engagement ring.
That's so good.
So like it doesn't actually have to be.
What a money saver.
He's the biggest tight ass, but it's special, right? It's so special.
That's so good. Well done. I'll give you a tip, and all the jewelers listening to this, feel free to write into me and say you are wrong. But I made not an error. It was just like a really moment when I bought a really nice diamond. So when I say like it was the biggest purchase of my life, like other than that house, but like it was a big purchase, right? And at the time it felt like everything. But I bought a diamond of a certain clarity, I think it was. And what actually happens is if you go for one of the really high-end ones, it can have that rating, but if you put it into a diamond, like a clasp or anything like that, it automatically gets downgraded in its clarity. And the reason is they can't confirm that the setting that you put it in isn't hiding imperfections. It was something like this. Some jeweler's going to write into me like, wrong again. But so what I did was I could have saved money if I didn't get the one that was like a few whatever's up, and just got the one that was like good to go. And I would have saved a lot of money. I didn't realize that.
That is really interesting. And yeah, like the setting can change like how the light reacts to it and all of these kind of things. But
it was the clarity. That's what it was. I bought a VVS1, if people know what that means. A VVS1.
Sounds like an ETF.
And I could have bought a VVS2.
I obviously like loved my engagement rings when I was married. But it's not really that important. And I think, everyone has their own values, but I think people put so much pressure on themselves to buy a certain thing. But if you think about your lifestyle goals and the things that you guys want to be doing, and if that means that you're not going on a honeymoon kids, or your home deposit, like all of that stuff. And maybe it doesn't have to be the forever ring. Like maybe it's a starter, like a starter home. Yeah. And then when you're in the financial position to get the amazing one that you've dreamed of, it's an anniversary. Like, why do we always have to have the same one the whole time? I'm obviously not going to, because I'm divorced. But
I'm going to buy my own. No. So another thing is, like the round diamonds that is all like the thing, like you see them in the movies and whatever. They're way more expensive than the flat or the round or the oval or the pear-shaped diamonds. I worked this out pretty early. And the reason is a round diamond is like obviously round, but it's also deep. And so what happens is when a diamond comes out of the ground, it doesn't come out round, right? They have to cut an existing diamond and cut the thickest part to make the round diamond. Yeah. So
like wastage.
There's a lot of wastage. So you're effectively paying for the full diamond, but you don't get it.
Yeah.
So that's why the pear shape and the teardrops and all those ones actually turn out to be way more value for money. So as the finance guy, the other half probably doesn't appreciate me saying this, but I was like, value for money? That one. And fortunately,
a bit different too.
Yeah, fortunately, what she wanted.
I think like the pear shape, was that like all the rage recently?
Yeah. So I think as the older folks say, I was on trend with that one.
I just love how much you will research anything from diamond rings to investment.
Well, yeah, I mean, that's one of those things. I think if it's important, I'll do the work. Next one comes from Fire Sapien, who says, my girlfriend and I just moved in together. How do we determine the best budgeting style for our relationship?
I love this. They might also benefit from those discussions we just had about
Yes,
engagement
2 for 1
rings. If
for
that's
Fire
on
Sapien.
your Okay, so they've asked, how do we determine the best budgeting? So it's really going to depend on your relationship and how you manage money. But I see most people default for the 50-50 expenses.
Yep.
And it rarely works. For some people it does. So I would be sitting down and having really clear conversations, and the more you can talk about money and it's not a stress you can be on the same team. Remember, it's you together against money, not money coming in between you. But just talk about different ways. So if you've got significantly different incomes, maybe it's actually in percentage to what you're bringing in. So maybe if they're earning 70% of the household income, they should be paying 70% of the rent, or whatever that works out to be. However it works now, I would also be having conversations that this might change.
Yeah.
So I've got some girlfriends that are now married with 3 kids, not working, like stay at home, working more than they've ever worked, stay at home parent, that they haven't changed how they manage money. And so it was always his money, theirs. And I'm like, that doesn't work anymore. It's so... your money, it has to adapt. So right now you might be working towards like the same financial goals, but keeping your finances separate. You might join some, but it's gonna adapt. And the most important thing is you having conversations about it really proactively.
It's interesting, Jem, with this, that can evolve over time. I think that's probably if I was giving someone this kind of money advice, I would say be prepared to evolve. And I'm thinking of some people that I know that you just don't know where they've come from into a relationship, and they might come from childhood trauma with money. Their previous partner, they may have gone through a messy separation. They might have had a great experience with their former partner. They might have had a partner. There's so many different things. They may have a vice. There's so many different things, and things we bring into a relationship. Communication, I believe, is essential. But so is understanding where people's beliefs come from. So Karen, Karen Ely, money coach, advisor as well, she does a lot of work with couples, and it basically goes back to those early thoughts and where those beliefs came from. Which
starts at like age 7. So you think you meet somebody at 20, 25, a lot of the damage is done. They can be pretty set in their ways, even if it's like subconscious.
Yeah. I remember my partner saying to me, like years into a relationship, it would have been 10, 12 years into a relationship. She's like, what are you afraid of? Like, because I'm like so obsessed with like trying to move forward and stuff. People who know me probably know that. Because when I was younger, I didn't have money. Mm-hmm. Like, I was always panicked about money. Always.
Mindset. Yeah.
And I'm just constantly running, right? And she's like, what are you scared of? And it wasn't really until she understood like where that would come from. She could help manage it.
Yeah.
And I could have that kind of realization. So that was really good.
And that's what you need to think of it. Like, you're both a team and you're both going to have strengths in different areas. So bring them together. So I've talked about it before. My husband was a spender and I was a saver and obsessive about like scarcity mindset. And he actually helped me relax a little bit and, it's okay to spend money and get a little bit healthier there. It wasn't like, oh, he's a spender, that's bad. It was, well, we both actually have these superpowers that we can bring to the relationship. Now, on that point, with couples managing money at no matter what time, and this is even for singles, right? You can outsource the execution, but not the understanding. So if you've got a financial advisor, you still need to understand. They might be doing it, but you need to understand. Somebody in the relationship might be doing the day-to-day stuff, paying the bills, have the internet banking, but you still need to know why we have those accounts, why we have that investment, what's happening with it. So you can outsource the day-to-day execution, but you can't outsource your understanding.
Like it. The NZBV, that's the YouTube handle for anyone who wants to look it up. Not so much a question. I just listened to the episode on passive income / income boosting. A minor income of mine is YouTube. I go on motorbike rides to get away from the computer screen. I started filming them and putting them on YouTube. I only make $100 to $200 a month. It doesn't cover my costs, but it reduces the amount that comes out of my own pocket. So I encourage other people to look for ways to leverage their hobbies. You don't need to make a profit if it's something you are going to be doing anyway.
I love that.
I love that. And I love the old, like the people that are a bit more creative, like the old furniture, buy the furniture online, do it up, sell it. Like I buy that stuff because I would love to do it, but I just don't have time. So
I love flipping furniture.
Yeah, it's so good.
It's like a creative outlet.
Yeah. Yeah, I like it. Sasha from WA does write in with a question. This one's directed at me. In a recent email, you mentioned that you'd never contribute to super under 45. Can you elaborate on your reason for this? This is quite controversial, Gem, and you might push back on this.
I am going to push back on this.
So in the email, for context, what I said was, if you're over 45 and you have under $500,000 of super, start making use of the catch-up contributions. This is where you can put extra money in super on top of your salary potentially and what your employer puts in and claim a tax deduction. However, if you're under 45, I don't think you should put extra in. So your contributions, sure, but not extra. And the reason is, I think it was 2016, 2017, maybe it was 2017, 2018. I counted there were 16 changes to super rules. And I believe if you're 45 today, you won't be able to retire properly until you're 65, which means there's 20 years of some bozo in Canberra making a choice over what your future finances is going to look like. I would highly encourage people not to put all of your money in one basket.
Not all of it. Yeah, I think it's so important to have assets outside of super, even though that's potentially the best place from a tax perspective for you. It's a balance.
Yeah.
So you want to make sure you've got assets outside that give you choice. So I had a coaching client the other week, and he is going to be retiring at 55. His super is at an amazing level, more than he will ever need. His issue is he's got 5 years of like struggle. And we talked about, well, it might be that you live on debt for that period because you know you can access it at X age.
Yeah.
It might be that you go really hard now saving and, but his issue is not funding his retirement. It's just funding a small portion because he needs to bridge that gap. So balance is really important. There are times where you really need to contribute to super because you are going to be severely disadvantaged. And that might be like primary carers.
Yep.
So if you take 5 years out of the workforce, like at 30 or whatever it is, that's going to make significant damage to your superannuation and compounding. So you might be talking to your partner about the strategies that you can do together. Do you put some extra contributions in before you go on leave? Do you plan to catch up when you get back? Are they going to split their super? Or there's different things that you can do. But I think if you're having time out of the workforce, like super is designed for your career just to go like, it doesn't take into account anything. Like it just doesn't, it's not realistic that that's going to happen for most of us. So if you are not putting money in every single year, you need to have a bit of a plan so the damage isn't done by that, I think.
Yep, I agree. So you can do things like speak to your advisor. You can do things like you can split your super contributions, the spouse contributions. There's a bunch of different stuff that you can do.
And they've all got different benefits depending on like what your earning is and what your partner is. Like even if you do the government co-contribution, what's that? You're earning under, like I think it's under 60,000 now. If you put a contribution in, the government will match up to $500. Like every year, you should just be reassessing, what's my income this year? Do I have disposable income? Does it make sense to put money into super or my investments or extra on my home loan? Like your strategy isn't going to be the same every year because there's different things you can do. So that's one of them.
I'm just an advocate of not going fast through one-way doors. And I think this is an instance. It's not completely a one-way door. Obviously, there are very few instances where you can pull money out, but they're not the type of instances you want to be pulling money out for. So I think build money outside of super, and younger people have the benefit of less risk. Have the benefit of time, but they have the exposure of more risk to rule changes. I think there will be more rule changes to super in the near term because the government has recognised they started with big balances that's coming in now, but they're going to try and eventually massage it so it's just like money outside super. Yeah. That's my long arc type story thing. But I've got a bit of pop trivia. I know how much you love math on the fly, Gem.
I don't have to do it.
If I have $200,000 in my super right now, and it's going to grow at 7.5% per year over 25 years, don't contribute any extra. 200,000, 7.5% a year, 20 years. Take a wild guess of where that might be.
849,570.
So you've seen my formula and know the outcome in the Google sheet. Okay.
Am I close?
Yeah. Yeah, you're within 22 cents.
Yeah. So I think there's some stats that I have heard that if you're under 37, super will likely be your biggest asset outside, and if you're over, it might be the family home second to it. So you might actually do some retirement planning, like jump on a calculator and go, based on, inflation, what I want to live off, my super might actually be that it's going to get you to where you need to be at 67. And so you do decide not to put extra in, and you make, an informed decision to build it outside so you can take a mini retirement or, retire at 50 or whatever that looks like. But it's just about balance. But like we said, just pretty much every time I open my mouth, you can change your decision, right? So you can put money in and then next year it not make sense because interest rates have gone up or you've bought a house or your strategy's changed. And you don't, another thing is people seem to think it's kind of all or nothing. So say you want to be putting $200 a week into super, but you're just not really sure. Why don't you do 50 or 100 and put that other 50 or 100 into a bank account, and then before the end of the year, just reassess, look at what you've been earning. Are your goals still the same? Has something come up? And then you can put that money in. Like, you don't have to be doing it. Yes, there's benefits for doing it more regularly, but if you're not sure, you can keep your options open for as long as possible and then make a decision when you have more information.
Yep, I like it. Okay, the next question. It comes from, Monty. Monty says, is it worth switching over my super if I can save on fees? Gem, you're the super, I don't know.
Super nerd?
Super nerd, yeah, we'll go with that.
I love it. Okay, so fees are very important. They have a big impact, but cheapest isn't always the best. Like if you think about quality and buying something from Kmart versus somewhere else, so fees are a very, very big consideration, but they need to be considered with, there's three things: the fees, the investment options that you've got access to, and their performance. And we don't care about the last year because it doesn't tell us anything. We want to look at a long-term period. So you want to be looking ideally 10 years because it shows different cycles. So you want to be looking at you can get the investment option within that fund. It's a reasonable cost for the benefits and things, and the performance you want to look at. And then, like we touched on in the protection episode, the insurance, it might be that it doesn't make sense because maybe you can get your insurance there, but the premiums are much higher, or maybe you can't get insured for something that you've got. So in saying this, a big misconception is that you only need one super fund. There was marketing for years, consolidate, you're paying double fees. You're paying a double admin fee, which for most funds is under $100, if that.
All.
Yeah. So it's okay to have more than one super fund if it's strategic and not out of head in the sand. So I have two super funds. One has the bare minimum amount to keep my insurance active, and I just monitor that. And the other one has my investments in it because I couldn't get the insurance there and I didn't like the investments in that one. So now they work together.
I like it.
Bit of extra admin, but yeah.
Okay, it's 30-year-old trying to get his dad to seek financial advice says, I am trying to get my dad to go to visit a financial planner / advisor. As someone who has grown up in a family where money and investing was talked about freely, I got myself into learning this important aspect of life, and I see the importance of a financial advisor, especially at the age where my dad currently is, but he keeps on delaying. How can I talk to him about this more openly and show him the importance of financial advice when nearing retirement? That's a really, really good question, is how do you what's the old saying about you can
lead a horse
to water, but you can't make them drink?
Yeah. And there could be a few things going on here. That he doesn't want to get advice. It might be that he is actually worried about what that outcome is, or that he just thinks it'll work out, his mindset. And I think it says that money has been talked about, but I think it might have meant hasn't. So that's why this person was doing their research. It's a very, very confronting thing for people to deal with money. It usually comes with a lot of shame. He might be thinking that he's choices are going to be judged, all that kind of stuff. But also, this is a really heavy thing for this 30-year-old to be worried about. Like, to worry about your parents not being okay is like, that's tough too. So, yeah, I really feel for this person. But, you know, maybe it's maybe it's just making some calls and talking to an advisor so you see that they're not so scary, or talking to a coach. And
I would so one of the things, a bit of a secret sauce that I happened to stumble upon through just fate and good fortune, I guess, was that what we realized from our events 2 years ago was that it was profound when you brought a partner or a friend along to one of our events. Mm-hmm. Because the other people that you brought along, or the person that you brought along, realized that it wasn't just crazy old you talking and thinking about money with them. It was actually a room full of people that just looked like them, and they could see us up on stage talking about things and then talking to them. And I think everyone kind of realized that talking about money is okay. And so maybe that you can change the environment to change the perception or the opinion. So I would maybe think maybe I invite your dad to something that he might be remotely interested in, that he thinks he's doing you a favor. So, for example, you might be like, hey, I'm going to go to this thing. I've got no one to go with. Can you come with me?
Manipulate him into it.
Yeah, just so he's exposed to it, right? And he can see, and you can be like, hey, I just need your help with this one thing. And you can slowly just work with him. And don't, parents everywhere will say this, you don't want to be lectured to by your child. Mm-hmm. So maybe it's not so much that. Maybe it's like they're supporting you. Role reversal, allow them to help you, but inadvertently, obviously, you're trying to just expose them to good habits. I try to do that with like people around me, to be honest. Like I try and just incrementally every time just do something. Or maybe if your father is not really like a personal finance type of guy, maybe he's an investor. Maybe he considers himself a bit of a know-it-all when it comes to property or shares or something. Talk to him, engage him at that level. So what do you think of this share? I'm thinking of buying it. What do you think of this property? Like, do you think it's like investment grade? Can you come to an auction on the weekend? I just want to see prices in this area.
And so more engaging stuff rather than you need advice, you need to go, like, rather than coming at it from a totally different angle. And I think you also need to know when you've done enough and
big one.
It's not your problem, and you can't help everybody.
I empathize with this person because you can see it in different walks of your life. If you've got a partner or a family member or a loved one that is dealing with something, whether it's drug addiction, depression, whatever, you know that it is your problem because deep down you want to help them. Mm-hmm. But at the end of the day, you do need to know when enough's enough.
Yeah.
And speaking of someone who's been through that too, Gem, like there is only so much rope.
Yeah. Exactly. And maybe the other thing is that they've had a bad experience with advice, or they've heard like terrible things, and they're worried about that as well. But it might actually be that they do have a super fund or something, or it might be just getting them to talk to their bank initially, like something that they're more comfortable with the brand, and it's not so foreign to going to see a financial advisor in a fancy office with a suit and a white, maybe it's okay. I will let's go to the bank and ask a couple of questions, or let's call the super fund and ask a couple of questions. Like, just there's going to be ways that you don't have to go from 0 to 100.
Yep, absolutely. The final question for today comes from Penny McSavvy. And remember, we'll be back for more questions in the next couple of weeks, as well as lots of great episodes. So if you haven't already subscribed or send us your question, you can do that in just a moment. After I put this question to Gemma Mitchell, the question from Penny McSavvy is, can you explain how salary sacrificing for a car lease, in brackets novated leasing, works, and is it worthwhile?
Okay.
This is a question I get a lot. I've never asked it of you, Gemma, so I'm keen to see what you come up with.
Yeah, so I try to avoid talking about car leases and this stuff because it's really, really complicated. So we're just going to go very basic on this because it's so detailed. So what a car lease is, or a novated lease, it's where your employer lets you package a car. So it's kind of like a car loan, I guess, and it usually has like mileage, fuel, what you might spend on servicing, kind of all packaged up. So say the car and all that stuff's estimated to be like $60,000, and then the repayments for that, the lease, the payments to maintain all of those expenses, are taken out as a deduction before you're paid your net pay. So essentially you're making repayments for something, and at the end of the lease, it might be a 5 or a 7 year, there might be a payment that you make, and then you own the car and you don't have those ongoing payments and there's no tax advantages. Like it's all just as if you had a standard car. Or you might decide to renew the lease and get a new car, and then you just keep doing the same thing. So that is my understanding of how they work. In my experience, people so they hear the word save tax and they go, yep, hard and fast. If I can get access to that, I should be doing it. I don't often see the numbers work because you're making repayments on something that you might never own. The other time that I see is people do them when their taxable income doesn't warrant it, or they're not going to get the use out of the car, like the Ks and stuff. Talk to an accountant. Get a quote from the car leasing place. So they'll do a quote for the car and everything, and you can look at, right, this is how much my net pay is going to go down. After 5 years, what is that worth? All of that. So there's ways, get the quote if you're considering it. Talk to the people about it. Of course, they're going to try and sell it to you.
I would say give it to your accountant to have a look at.
Yeah, go to the accountant. And then the other thing where people get stuck with this is I see people going, I've got 20 grand in savings to buy a car. Oh, look, work's offering me this lease. I'm going to get the $80,000 car. And they've just gone, I'm like, you are so much worse off. Just because you're saving tax doesn't mean that you're better off. I see it change people's like acceptance of what kind of car they would want and stuff too.
Yeah, I mean, it's like fake money, isn't it? If the company's buying it for you, it's not real. What's that? It's mental accounting. Where money comes from, it's totally different.
But I'm saving tax. I'm like, but you're still way worse off than you would be. There's who says it? Is it who's that really opinionated? Dave Ramsey, is it? He's like, drive the cheapest car your ego can afford. So I find that people are kind of okay to do that. And then as soon as novated leases are on the table and the tax saving, they're just like, actually, my ego wants this car.
Yeah. It's so there's a massive tax loophole at the moment. I would say, no, it's not a loophole. Let's call it what it is. It's just an incentive to buy an electric vehicle if you are a small business. And so that novated leasing does actually apply to that. So don't even ask your accountant about it because they won't probably know what I'm talking about. But what you can do is go to the ATO website, electric vehicles fringe benefits tax, send that to your accountant so they actually have a basis, and they'll be like, you can do what? And let them crunch the numbers for you, because that's the only secret source that I can think of in terms of buying vehicles at the moment. Trades and those types of things that have full use of a vehicle probably don't have to worry as much. But for anyone else that's trying to do some tax something or other to get a car, minimization, just don't take whatever the fella at the car leasing place is trying to flog.
Yeah, you just need to make an informed decision, and not everything has to be the cheapest or the most sensible financial decision. Like, money's a tool. Like, if you're going, well, I can access that a nicer car and I'm going to use that, and that is going to be of value to me. Like, it doesn't have to be the cheapest option. You just need to have made a decision with all of the facts and be comfortable with it.
Yeah, it's not. Just rule this myth out. It is not like free money. It is not like an excuse to spend more. It is just definitely not that. And that's what it's kind of, some people think it is.
Yep.
But the electric vehicle thing is legitimately real, because I did take advantage of that. It's interesting how this, speaking of cascades, how this comes full circle. Queenie told me about it. I think I told Jordan about it. And then I told Drew and Jamie about it. And then all of us ended up with electric vehicles.
Now you've all got matching Teslas.
Yeah. It's not because we were schoolyards. It's actually just because it made sense for the maintenance and that sort of cost. But I had resisted novated leasing my whole life. And in the third podcast episode I ever did in 2017, I spoke to a guy named Tony Hansen, who was a CPA by training. And he has this theory. He has quite a few, but this one in particular was quite interesting to me, which was that he said that depreciation is the silent killer of the middle class. And so what he was saying is the value of things that you buy that goes down, that's the stuff that kills you financially. And you don't realize because it happens in the background. You go get a new Kia, you drive it out a lot. Whew, look at that Sorrento. Now it's worth $30,000 less. That's real money. Mm-hmm. You're now paying a $70,000 car loan for a $40,000 car. That's a silent killer. And it happens with all types of things, TVs, mobile phones, computers.
And on really small scale, like if you think of like, I know so many people that have got the salvos bag in the back of in the back of the car that they're driving around for months. I'm like, that's money. That used to be hundreds and hundreds of dollars. Like,
yeah, that's a great
we just
way
need to be really mindful of what we're spending on and if it's adding value. And if it is, cool, that's okay to spend your money on it. It's your money. But you just need to make informed decisions.
Yep, great. If you listen to this show, if you're a sole trader, Mr. Ring, the NZBV on YouTube, Sasha from WA, 30-year-old trying to get his dad to seek financial advice, or Penny McSavvy, you guys will actually get a free piece of Rask merch just for asking the question. I did say in the email on the weekend, the first 10 questioners this year get some free Rask merch. So if you haven't already received an email for us, write into us via the website. And hey, you never know if you get your question in for next week's show, what you'll get for free.
And can I put a request in to Mr. Ring to when he sorts this engagement ring to send us a photo?
Yeah, let us know.
And tell us, what it costs, what your strategy was.
Yeah, so just full disclosure, I have no relationship whatsoever to Joggy or Diamonds. But when I did call them and I was stressing out of my mind spending all this money, I called them and they basically, this is the conversation in short. It was like, who's this? What do you want? Yeah, it's a ring. No, we'll send you. Yeah, no worries. See ya. And it was basically that. And I just came away more petrified than I did going in.
But I still
bought it because it was such a good deal.
It's a deal.
So what I mean to say is hopefully they're legit still, like they were back then. But obviously do your research. It's a big purchase. Take your time and let us know how you go because it's exciting. Gemma, you're a money coach. People can find out more about you. They can follow you on Instagram. That'll all be available in the show notes. You're a money coach, advisor. Go reach out to Gem if you want to book in a call. There is a link there too. So thanks for joining me.
Thank you. Bye.
Thanks for listening to this episode of the Australian Finance Podcast. Our show sponsor is Betashares, one of Australia's largest ETF providers, and indeed the largest by number of ETFs listed on the Australian market. In the next couple of minutes, I'm going to give you a brief overview of the Betashares India Quality ETF. Let's break that down. Betashares is the issuer of this ETF. It's focused on the Indian stock market. It invests using quality filters, and of course, it is an exchange-traded fund, meaning that you can buy it in your brokerage account under the ticker symbol IIND. Let's focus in on the Indian stock market. Now, you may know that the Indian economy overall is one of the fastest growing in the world. Indeed, it has some of the most innovative companies in technology and many other respects like industrial industries as well. And so India really is an economic powerhouse. However, one thing happens in many countries that are growing fast is that the stock market doesn't always keep pace with the growth in the economy. And you've probably heard Warren Buffett say a phrase like, the stock market is not the economy and the economy is not the stock market. However, buried within the Indian stock market are some great companies. And this is illustrated by the general, makeup of the Indian stock market. The Indian stock market has a very narrow concentration, and what that means is the biggest companies make up a huge proportion of the overall stock market's value. It's kind of like here in Australia how the biggest companies are banks and mining companies, and they make up a really big share of the overall stock market's worth. In India, however, as kind of a country that is emerging with lots of growth, what we find is that one of the better ways to invest over the long term tends to be a way of not index investing, but kind of like that in that it screens for companies and weights the companies within the portfolio in a different manner. So in places like India, I tend to prefer different types of strategies other than just plain old vanilla index investing strategies, which just say the biggest companies get the biggest share of the portfolio. That's not what this ETF does. This ETF screens the Indian stock market for companies that exhibit high quality factors. These would be things like low levels of debt, consistent profitability, and high profitability. Things you would probably want in your portfolio anyway, but it does this to avoid certain pitfalls that come with investing in a stock market like India's. Because this ETF invests in a way that's a little bit different to the broad stock market in India, what you're left with is what we call outperformance potential. So by investing in quality companies, you have the potential to do better than the broader stock market. Another thing that's quite interesting about the Indian stock market is that when you're an Australian investor and you put an investment of like Australian shares, maybe some cash in your portfolio, and maybe some US or global shares, is that the returns from the Indian stock market have tended to be, although it's not always the case, have tended to be uncorrelated or exhibit low levels of correlation. So what we mean by that is that it tends to move in a different way at different times to the Australian market. And ultimately what that adds to is the diversification benefit you get from adding a little bit to an overseas stock market. So India and IIND as an ETF, I think, can be thought of as a good satellite exposure or tactical exposure in a portfolio. So while you may have a core exposure to certain markets like the Australian share market or the global share market generally, you can also kind of bolt on a little bit of India if you have conviction in the long-term outlook for the Indian stock market overall and the quality companies that are in there. Now, we're recording this video in January and we're recording it here in Melbourne. And at this time, the Australian Open is on. And one of the biggest sponsors of the Australian Open this year is Infosys, which just so happens to be the biggest company inside the IIND ETF at the time of recording. It's a digital leader around the world embracing things like AI and cloud computing. That's an example of the type of company which could be found on the Indian stock market. Now, of course, when you invest in markets like this, you can expect a few more bumps up and down, and you also do want to keep on top of what's happening with the ETF, generally speaking, and pay attention to how it's performing in your portfolio over the long term. One final thing is you can also use this ETF in your core. I mentioned it could go in the satellite, but you could also use it in the core of your portfolio because a lot of professional investors include something called emerging markets in their portfolio. This includes shares of companies from regions like Asia, South America, and indeed India. So if you wanted to include this in the core of a portfolio, you could say, hey, well, I like emerging markets and I think it's part of my portfolio in the long term, but I don't want the Chinese shares and I don't want the other Asian shares and I don't want the South American shares. I'm happy to have a little bit of India in my core too, but I think position sizing is appropriate. You can learn more about the IIND ETF by visiting the betashares.com.au website. And I would highly encourage you to check out the fund page. So when you go to their website, the IIND landing page has the top holdings, it has the fees, and it has a product brochure that explains why India, how it works, as well as the PDS, that's the product disclosure statement, and TMD. You can find all that information on the betashares.com.au website. Thanks for listening to this episode of the Australian Finance Podcast. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.